The Dow is indicating a decline for the sixth day in a row amid political concerns in Europe. One bright spot is Disney, who beat earnings estimates last night and is trading up this morning. I'm Taylor Schranza, and the morning call starts right now.
Good morning, I'm Scott Rudd, the Chief Strategic Officer of T3Live.com.
And I'm Lindsay Bell with The Street, and together we bring you the morning call. Last week, markets went into corrective mode with a weak jobless claims number and the big jobs report that wasn't so great. And then this week, we come into negative news out of Europe. But it seems like a lot to absorb for traders. Yeah,
it's been a lot for the market the last week or so. We've been in a nice uptrend. The first quarter we have huge gains. So we came into the second quarter saying, you know what, we're going to digest and potentially correct a little bit. So then late last week, all of a sudden, the claims continued to disappoint somewhat. And then you saw the jobs number on Friday. It wasn't robust and actually was a little bit lower, showing more of a negative trend than we've seen over the past year or so. And then, a lot of and then all of a sudden you have Greece that went back to where everyone thought they already did an orderly default. Now they're looking for another default, and there's turmoil over there. And I think really what really shook up this whole formula of negativity was the elections in France. Now people have no idea what course they're going to take. They're going from deficit reduction and potential austerity to now they want to spend their way out of it, or tax and spend, which is not what U.S. traders or U.S. market participants wanted to hear.
So it's starting to feel a little bit like 2010 and 2011, where we saw the market take a big drop off the highs. Is that going to happen again this year?
It seems like we're in motion for that going on right now. I don't think it's going to be as extreme as we saw the past 2 years, because if you recall back in 2010, the market was actually, I think, 17% off the highs. Last year it was 22% off the highs. So that's why I'm saying when we're only 5-6% off the highs, why are people so up in arms? With everything that's going on in Europe, and obviously U.S. is on a better path, but we're not, in rocket space going nuts as far as GDP and whatnot. So why not pull back 7 to 9% off the highs? And if you look at the chart of the S&P, you'll see technically it's been adding up. If you look to where we had this uptrend that we've talked about so much since October, we broke this uptrend, I would say, early March. You then had a move lower, okay, where we found support. You had a bounce back, and then the market looked okay right around here, but then within this little range, we saw some technical faulty signals. We saw the Dow leading, we saw Tech and the Russell lagging. So once we broke this 1390, that was your key to get out, and I think a lot of short-term intermediate traders got out. So then yesterday, I will say yesterday was a tricky day. And before I go into a little bit more of a long-term thing with the chart, yesterday you had a reversal. A lot of traders, when we talked about 135.76, they got short. You made good money, then it came back up and retested it, and then it squeezed through 135.76 and closed pretty strong. So what that did is it squeezed uncommitted shorts and it baited in new longs. So if you're one of those guys that actually went in a little long, because I dipped my toe in for a rental long, because anytime you see a reversal pattern, like I'll show you here in the spiders, sometimes, you get a little bit of follow through. Sometimes. Obviously, this is showing us how weak this market is. You had a little bit of a reversal yesterday. Okay, so I was thinking, maybe we get a cute long, I call it, back up to 137.75 or 138. Didn't happen. We're opening lower, we're opening near yesterday's low. So I would watch this 134.92. If we break this 134.92, just salvage a trade, get out of the way, see where we can go, and then figure it out. And if we go back to the chart of the SPX, you will see that this macro pattern, okay, that is in place right now, this sloppy head and shoulders pattern where you have the left shoulder, the head, the right shoulder with the neckline, it equals a move from about 1420. Okay, you go to the neckline of about 1360, that's about 60 handles, and that takes you actually down to about 1300, and there's another point of reference here around 1320. So on a macro level, I would say for investors, this would be a spot that I think is compelling to buy. This would be about 7-8% off the highs, and obviously as a trader, you have to maneuver for cash flow, but what I will say right now, less is more.
And you know what? We've been watching leaders this whole entire time. And yesterday they traded down just like the broader market, but they were really able to pare back some of those losses. Let's take Apple for an example. They actually traded into the green towards the end of the day down though. But what are you looking at in Apple?
Well, I think as a trader, that's all you have to focus on. Don't focus on second, third, fourth tier stocks. look at the leaders. The leaders will give us clues to how the day is going to unravel. And yesterday, a lot of those leaders hit their lows, right around 11:30, and then had a nice bounce off it, showing you that you can make money in these travel ranges, but you have to be quick and nimble. So for right now, if you look at Apple, you will see, which I'm actually long a little because it is the leading stock, not a lot, but a little. It's been trying to hold this 560 area. This 555 is really big. So today what I'm going to see is, does it hold above this previous 2-day pivot? Can it potentially break above 572 for continuation? As of right now, it doesn't look like that. But if it breaks this, I'm out. Then I'll see how it handles this 555. And if Apple were to break this key support for now, and we get to move down to the bigger support, which is around 517, which is the 100-day moving average, or 523, you're going to see 1340 real quickly in the S&P, and probably even lower.
What about JP Morgan? It is the Apple of the financial world. So what are you doing with that stock?
Right now I'm flat, and I'm going to look to see if I can get a cash flow long here also. It's down 40-50 cents pre-market. It didn't bounce yesterday. The financials didn't participate in that move. That's why I was very light overnight. I wasn't even going to take any longs, but I said, you know what? We had a bit of a reversal strategy. I'm an active trader. Got to go with the active strategy. Almost like hitting with an 11 versus a 6. You have to do it, even though if it doesn't feel right. So if you look at JP Morgan, here you go. It's coming back down, as high as 46. It's been working its way lower. It's coming into a very big moving average here, this 39.72. I'm not sure if it gets there today, but look at where it broke out from. It broke out from right around 40.40. So I would say from 39.70 to 40.40, if you sold, into strength, into JP Morgan, you sold on this potent down day when it didn't act well into earnings, you have the luxury of trying to buy back right in this area. So today, JP Morgan will be one that I'll see if I could make some money cash flow wise.
LVS has been another leader. What are the levels, the key levels there that we should watch?
LVS, it's like almost a round trip back to that channel that it broke out from. I was very excited about LVS this year because there was a weekly channel that once we broke above 50, we put a target in north of 60 and it went to 62. But just like anything, you got to take trades. Okay, you have to time the market. You can't just sit tight. You're not going to make money that way, or at least you're not going to create alpha. So if you go to LVS, you will see, stock had a basic round trip here. Okay, if you remember, this was the breakout area. This was the breakout above this channel of about like 50 and change. And then I remember being on Cramer's show talking about another momentum move right above this, this bull flag right here. Shows you how you could time things. This was like almost 54. Then look at this little reversal bar. This reversal bar was a sell signal right into 62, which is right around the target of the year. And then obviously it's been, coming in just, showing absolutely no strength. So yesterday it was one of those candidates that bounced off the low. So I would say right now this is something to watch. If you sold into strength, I think you could buy back into the 50 area. Maybe it touches the 200-day a little bit below 50, but I'm also going to look at this for cash flow and a potential macro trade. I think right around 49 to 50 and change is a compelling area to watch and potentially buy.
Consumer discretionary in general came under pressure yesterday for a number of reasons, but we really saw some high multiple names take a hit early on, but they also rebounded. One was Lululemon. I think Europe may have had an impact on that because we heard from Fossil that their Europe business was terrible, but Lululemon has one store in Europe, but the stock has had a 60% run so far this year.
So I think you combine all of it, where when you have emotion, people don't read between the lines. And one store doesn't mean European exposure, but it's also had a big run. It's a market leader. Things are correcting. So, with the run that LULU had, why wouldn't this correct also? So if you look here, I think we talked about this yesterday, and I drew a line, which was right here. This was your first line of support. So yesterday as a trader, if you wrote down 70 and you bought it versus support, you had a nice move. So today it's probably opening down. I think, you could trade it long versus level, but overall, we start correcting lower. I don't see any reason why. If you look at this macro chart, it can come down to this 100-day, and the 100-day is around 65. So as a trader, watch 70. If it can't bounce off there with a lot of strength in the next few sessions, you might be seeing this lower level here at 65. So here's support 1, here's support 2, short-term traded versus this support floor right there.
Ralph Lauren was another name that got hit. They do have 20% exposure to Europe, but they've got a broader product mix, and they've been focusing on expanding into Asia and further into the U.S. This is a name that Stephanie Link at Action Alerts Plus likes and has kept an eye on.
I'll say, again, corrections don't, what's the word? They don't discriminate. They usually come after everything. And what's interesting here is you say they have 20% exposure. Maybe the market knows it, because if you saw LULU, it's above the 100-day, it's above the 200-day. If you look at RL, you will see that it actually pierced the 100-day and touched the 200-day. So RL right there showed you relative weakness to LULU. So just something to, to acknowledge. So at this point, I think you could trade it versus yesterday's low. But if it breaks yesterday's low, goes below the 200-day, it's probably going to be in the penalty box for a bit longer. And if you look to see where it came from, I guess this would be something that can go a bit further. And then you have like really, really big support that comes in right around 140. So use this 200-day as a level, and then this 140 as a level.
And right after this break, we're going to talk about another trend, the trend that we've seen in commodities, and talk about who can benefit from that.
Hi, I'm Sean Hendelman, CEO of T3 Live, where we train, coach, and mentor traders in order to help you put your money to work with confidence. The T3 Live approach is a blueprint for you to recognize, adapt, and ultimately take advantage of different market conditions. To begin your training with T3 Live, we would like to offer you the opportunity to enroll in our free 30-day online home study course. Fill in your name and email address, and I'll see you on the other side.
Oil is down $9 since the beginning of the month. This obviously is not a good trade for oil companies, but it's good for the consumer and transportation companies, to name a few. Let's talk about Costco. This stock, got hit last week when sales numbers came out that were weaker than expected. But, this is a place that the consumer could go and spend their extra discretionary dollars at.
Yes, and I guess if oil continues lower, they'll have more money in the pocket that way. But overall, again, we've been talking about sticking to leaders. And as I look at the chart here of Costco, if you want to take a look here of COST, you will see that it's already below the 200-day. So not only did it break the 100-day, break the the 200-day, it's below it. So to me, I don't think this should be a focus during the correction. I know that fundamental investors like to buy stuff really low. Here was your technical way out. You had a little bit of an ascending channel, broke to the downside, and then once it broke this key support, you really had to get out of the way. Now, if you look at it, from a macro stance, I guess, as the correction deepens, and if you really want to buy it all the way in the hole, I would say you have to wait all the way down to about 78. I would not be touching this thing right around here. I'd say wait till about 78-ish.
Kraft is another name that Stephanie Link at Action Alerts Plus owns and likes. It's in the consumer staple space, which has been a little bit questionable, but these guys have a spin-off coming. They're spinning their grocery and snack business, and they've got a great dividend. But what are the technicals saying?
This one technically is acting much better. It just broke out. It's pulling back to above all the moving averages. Look at the difference here in Kraft. KFT, I guess they're making it like a safety play also. If you look here, you'll see, this was the last time it broke out. It broke out right above this level. So for it to just be pulling back to like the 10-day moving average, this is showing you strength. I do think you don't have to jump in this second, but if it were to get down to this area, or again, here's the 100-day, I think the strong stocks out there are going to hold the 100-day while the markets try and work their way to the 200-day. So for right now, I think Kraft is in the game technically as a good technical play, as well as some bang for the buck with a dividend and safety.
Transportation companies will obviously benefit on the expense line. Taking a look at Boeing, this is a company that really had a great pop after earnings, and Stephanie Link owns it, likes it, but she's thinking about getting into it closer to the low 70s.
Okay, so let's take a look and see where that price is on the chart. This did act well a few weeks back, and if you look here, you had a nice wide range bar to break it above this big consolidation. Okay, if you remember that we talked about this for a while, it took a long time to absorb this move from earlier in the fall. You had a nice tradable move up, and then it sort of broke this mini flag here, rightly so, because the market also came under pressure. It too is above the moving averages. I think this is an investment to stay with. You could be in tier 1. I wouldn't be in tier 2. And at some particular point, if the market gets a bid and we start to get back in more of a positive stance, we will break above this 77.83 for some momentum. But right now, the market's not letting many things break out until we're done with this phase.
Eaton's another name that their margins should benefit from oil and gas prices in their automotive and their aerospace businesses, where the charts look like there.
This one doesn't look so hot. I'll tell you right now. I think I've looked at this a few times where I'm like, I always try and make a caveat for this thing, but overall, it has not acted well. And if you look here at the chart, you will see that, you know, you have a high, lower high, lower high, lower high, lower high. And now what are we? Below all the moving averages. Red Dog doesn't like getting involved with stocks below all moving averages. So at this particular point yesterday it actually reversed well with the market. So if you want to look for one positive, it did give you a little reversal here. So potentially a bounce back to resistance would be okay. But with today's weakness, I'm sure it's going to remain under pressure. I'd rather you see this, you know, or see you get involved with this thing, especially if the S&Ps head down to 1320-ish. You'll be able to buy this thing a little bit closer to 41 or 42, not up here around, you know, 44 and change.
Why don't we take a look at some quick hits? We're going to kick it off with a controversial name, Green Mountain. The latest news there is the two directors got demoted because they had to sell a chunk of shares, given margin calls. What's the chart looking like? I know it's down big.
Well, at least earnings are out of the way.
Yeah.
What I wouldn't do is I wouldn't take this overnight at all. But intraday, there's some moves. And yesterday, the stock was up a decent percentage, just showing how you could time things a little bit as long as it's intraday. So if you look here at the chart, this was the last time it hit a disaster. This was, you know, this also goes to show you that you never know how cheap stocks are. People were saying, oh, Green Mountain's so cheap. Look where it came from 120. Let's give it a shot at 50. So now, you know, if you're not involved in earnings, it's not your problem. There's a huge short interest here, and maybe some of these executives got stopped out and will relieve some pressure. So I think as a short-term trade, if this gets above yesterday's high of 26.48, I think you could play it, and then the next level will be where the gap starts. So above this area right here, I think you do see a squeeze, and then right down this pivot right here of 30.29. If it gets above this, you will see, you know, a further squeeze. So I think from a day trader, I think guys will focus on this because it was so green yesterday above this area. I think you go with it and then watch to see how it handles the gap. But I will actually put this one on my radar today.
How about McDonald's? Yesterday they reported weaker than expected same-store sales, so the stock traded down. Is it a buying opportunity, or does this stock have further to go?
McDonald's, I've been talking about for a while, how it's like changed its composure. I think like a month ago it came out with some bad news, and then people tried to forget it because it's McDonald's. But PS, you know, if you look at the chart here, it's not looking so good. This one already is at the 200-day. So if you look at other strong stocks that aren't near the 100-day, this one's at the 200-day, so it's showing you relative weakness. And ever since, you know, I don't remember exactly what day it was. It could have been this gap down right here. I remember it. You know, people tried to blow it off. It came back up to the downtrend and it got rejected. So you have a series of lower highs in place, and it does seem like it's starting to accelerate to the downside. I'd watch to see it at the 200-day here, but if it breaks 92.97, I'll have to give you actually a more macro view here to see where it can go. And if you look here, this thing could probably get down to $90. At $90, maybe it'll be a better buy the dip, especially if it breaks below yesterday's low on the 200-day. So right now, this is showing more technical weakness than strength.
We did see strength, though, out of Dunkin yesterday. That was a stock that ended in the green.
Dunkin Donuts, if we weren't in a corrective phase, I'd probably be in tier 3, the way it's acting right now. It's a new issue. I think there's a great growth story. They opened up their first one in India. Who knows how many more they're going to open up. You know, this stock to me, you know, every now and then there are some stocks that come out that are new issues that take a year to 2 years to incubate, and then they have explosive runs. So I think to me, if you would have bought Starbucks in the first year or two becoming public, or maybe McDonald's, you're very happy. Not saying that this is the same thing, but I think this one could be something for your 401k, your IRA, and also as a trader. So if you look here at the chart, you will see, you know, here is the IPO that came public, and I've had it listed a few times, so let me get you to the right chart. First time we talked about it was when it broke this little flag area. If you guys remember, it was right here. It was looking great, nice cup and handle. Here is the cup, here's your handle. This was your breakout buy, and then it had its secondary. Okay, so it came in, absorbed the secondary. Now, look where it is. Look at, it's above the 100-day, it's above the 10 and 20-day. That's showing some strength. So if we have a strong day in the market, I think there's no reason why this thing's not going to break above 33.50 for a move that potentially could take it to 38 to 40 at some point in the next year or so.
How about Google? That's been another strong name. Can it continue going higher?
I think now that everyone's talking about Facebook and the valuation, people are starting to think Google's cheap. So it's acting better. People are saying, okay, $100 billion valuation for Facebook, and you look at the revenues of Facebook, I don't know how people are going to swallow that. They're saying, oh, Google, I'm not sure exactly what their valuation is, but I think it's like $200 billion, and they have 5 different businesses, and they've also proved themselves. So right here, Google has a nice little cash flow strategy, or a little setup where here's your 200-day. It held it after this poor report came out. Another decent report, held the 200-day again, so it's still doing that. And overall, it didn't have a big move with the market, but it's still percentage-wise doing okay, and it's coming into a lot of moving averages. If Google can get above and stay above this 615 to 618, I do think you're going to get a nice cash flow move. And if you're an investor and you've been holding and using the 200-day as your line in the sand, you're still there. And hopefully next quarter, finally they say something a bit more robust, and then we can get new highs on the year. I still like this one. It's just a little testy. You should probably be in a little less.
All right, so we talked about oil. What about gold and silver? Those two commodities also are getting pretty hit.
Gold I've tried a few times to get a trade to break its intermediate downtrend, but it never did. And now, after not breaking its intermediate downtrend, it's starting to break, long-term uptrends. So at this particular point, gold's been very weak. And, hopefully you had some stops. Hopefully you've been following your rules, because I know the gold bugs are bugging out on how weak, gold is. But you have to have rules in place. And if you look at the chart of GLD, it's just gross, okay? I'll show you the macro picture here. The macro, I remember calling out a top in gold on this outside day, or at least saying this was a day to take notice outside day. That was one way out, okay? And then on this day was Fed day. This is when the market said, we're not going to be supporting gold anymore, and pow. And since then, we've been in this intermediate downtrend, and every time we've tried to break out, it was a better short than long. And granted, I actually was long each time here, but at least I took small losses. Small losses are fine. Yesterday, big gap down, closed off the lows. I think we're opening below 154.92 today. I do think at some point we test this area, and this area is all the way down below 150. So I would just take a lot of caution in gold. I think in off the charts, Vicky's had the monthly chart up here. If you look at the monthly chart, if we go like this, actually let's go to the weekly real quickly. I know we're running out of time here. I want to show you how it's getting very, very close to breaking, what has been a longer term trend. I think we had this one as one, which actually it already broke right there. And now if you look from, I guess, all the way back, if you draw your line just, with a ruler here, actually, 140 will be key. And that's the real macro line in the sand, besides this pivot right here, which is about 154.
So given the market downtrend that we've been in the last few days and the uncertainty that's going to remain in Europe, would you say we should be watching the leaders then?
Yes, watch the leaders, not the second, third tier names. Don't go all in. If you trade for cash flow, make sure you use pivots. Yesterday, 135.76 was a great pivot. I made money short in the morning below it, and then I covered and then had a decent long above it. Today, that same pivot is probably 134.92 off the top of my head. If you're trapped in some longs after yesterday's reversal, like I have a few cute ones, but you know what? It was worth a try. If we hold that level, perhaps maybe we could work off the lows, but look at the leaders to see if anything could lead us off those lows. But if we break that, salvage a trade, get out of the way, and live to fight another day. And at this point, I think less is more as the market tries to sort through all these, pretty crazy headlines that we've been dealing with out of Europe.
So be sure to check back in with Scott at the end of the day as he reviews the charts.